This video is for educational and entertainment purposes only and does not constitute financial advice. I am not a licensed financial advisor. Always do your own research and consult a qualified professional before making any financial decisions. You just got a $1,200 tax refund. 2 weeks later, it's gone. You spent it on things you can't quite remember. A new gadget, a few nights out, maybe some clothes. That same month, you skipped a gym membership you actually wanted because it felt like too much. And here's the thing. You're not irresponsible. You're not financially illiterate. Your brain just filed that tax refund into a completely different mental category than your paycheck. And once it did, the rules changed. This is called mental accounting, and it is one of the most financially destructive cognitive biases most people have never heard of. Mental accounting is a concept developed by Nobel Prize-winning economist Richard Thaler. The core idea: human beings don't treat all money equally. We mentally sort money into separate buckets based on where it came from: salary, bonus, gift, refund, gambling win, and then apply different spending rules to each bucket. Logically, this makes no sense. $1 from your paycheck and $1 from your tax refund have identical purchasing power. They're fungible, interchangeable. But your brain doesn't treat them that way. Your brain treats found money, bonus money, and windfall money as somehow less real than earned income. And that psychological distinction, which feels completely invisible, is draining your finances in ways you probably haven't noticed. Today, we're going to break down exactly how mental accounting works, why it reliably sabotages smart people, and what you can actually do to stop it from running your financial life in the background. Richard Thaler introduced mental accounting in the 1980s after noticing a strange pattern. People who were extremely careful about routine spending would suddenly become loose with money the moment it arrived as a bonus or windfall. Same financial situation, same person. Completely different behavior, based solely on the source of the money. He called it the non-fungibility of money in practice. In theory, all money is fungible, totally interchangeable. In practice, we treat different sources of money as if they live under different rules. The tax refund example is one of the most studied. Survey after survey shows that people spend tax refunds faster than regular income, even though a tax refund is simply overpaid wages being returned. There's nothing extra about it. Your employer withheld too much throughout the year. The government is giving back what was already yours, but your brain encodes it as a windfall. A bonus. Free money. And free money has a looser set of spending rules. Same with gambling winnings, gifts, or any money that arrived outside your normal paycheck. It feels different, so it gets treated differently. And that difference costs you. Mental accounting doesn't just change how you spend windfalls, it shapes how you carry debt. And this is where the real damage accumulates. Here's a scenario that plays out every single day. Someone has $6,000 sitting in a savings account earning 1.5% annual interest. They also carry $6,000 in credit card debt at 20% interest. Mathematically, the correct move is obvious. Pay off the debt immediately. The net gain from eliminating 20% interest is not close, but many people won't touch that savings account. Why? Because in their mental accounting, the savings account lives in the security bucket. Untouchable. Sacred. The credit card debt lives in a separate, manageable debt bucket with completely different rules. Those two buckets don't interact, even when they absolutely should. This mental separation costs people thousands of dollars a year in avoidable interest. Then there's the bonus trap. People who invest their regular paycheck carefully will often blow a year-end bonus on luxury items or high-risk investments, because in their mental accounting, bonus money has a higher risk tolerance. It came easy, so it goes easy. The result: financial split personality, conservative with regular income, reckless with everything else. Mental accounting can also make you irrationally protective of money that should be working harder. People keep large emergency funds in low-yield accounts because that bucket is sacred, while simultaneously carrying high-interest debt in a separate bucket they're paying down slowly. The logical move would be to merge those two realities. The mental accounting to rewire your mental accounting instead of being controlled by it. First, apply the paycheck test to every windfall. Before spending any bonus, refund, or unexpected income, ask yourself, if this money came as part of my regular paycheck, would I spend it this way? If the answer is no, redirect it to your top financial priority. Decide this in advance. Don't make the call in the moment. Second, name your accounts deliberately. Research shows that people save significantly more when savings accounts carry specific labels: emergency fund, house deposit, 6-month buffer. The label creates a mental bucket that's harder to breach. Use the same cognitive bias that's been working against you and point it in a useful direction. Third, automate windfall allocation before you receive it. Decide in advance how any bonus or refund will be split. For example, 60% to savings or debt, 40% available to spend freely. Pre-commitment bypasses the in-the-moment mental accounting that distorts your judgment when the money actually arrives. Fourth, track everything in one view. Mental accounting thrives in silos. When you look at a single account in isolation, the bucket illusion is strong. When you can see your total net worth, all assets, all liabilities, in one place, the artificial separation starts to dissolve. It's much harder to treat a savings account as sacred when you can clearly see it's costing you money in credit card interest every month. Your brain isn't working against you out of malice. Mental accounting is a cognitive shortcut, a way of simplifying complex decisions under uncertainty. In some contexts, it's genuinely useful. Keeping a mental do-not-touch category for emergency funds, for example, provides real psychological stability. The problem isn't the system itself. The problem is running it unconsciously. People who build real wealth don't have fewer mental quirks. They've just learned where those quirks cause damage, and they've built systems to work around them. That's the shift, not willpower, not discipline. Just awareness, and a few simple structures that account for how your brain actually works. If you want to keep building that awareness, subscribe to Broke Thinking. We break down the psychology of money every week. New video every Tuesday, Thursday, and Saturday. See you next time.